Going on, guys? Welcome back to a wholesome investor channel where we talk all things personal finance, investment, option strategies, trading, technical analysis, stock picks, all of the things relating to personal finance and growing your wealth. Today, we actually have something very special for you guys. So, we're going to be talking about passive income strategy. This is going to be a multi-part series, and this is going to be part one. We're going to talk about the flow of time and money and how to really think about your money, how to grow it. Let's get started. And in definition, the passive income is income that requires little to no effort to earn and maintain. And this sounds too good to be true. A lot of time when you run into passive income, it's in context of scams like pyramid schemes where they try to get you to sign up something and make money, get rich fast. But this is very different in that it takes a lot of effort to accumulate and build a foundation to have your income stream and cash flow to receive this passive income. So you are essentially putting a lot of work up front, but once it's built, you'll have money flowing in with very minimal amount of work, and that's the beauty part of it. Why is passive income important? Why do we need this? Why can we just work more? Always be on, having a side hustle, pick up a second job. That's what people always recommend if you need money. So there's really no excuses for not having money if you can just work more. That's definitely true. The more effort you put in, the more money you can make. But I mean, this is tied to your allocation of time is really finite, and people end up finding you're in this position where you're working so much and making a lot of money, but you don't have any time to spend that money because you're constantly working, and this is really soul crushing. So if you look at over here, allocation of time, this is how much time in your total lifetime, however you want to think about it, and certain amount of that is at your job working to make money. And what do you use that money for? It's really to pay for what you're using in life in expenses, whether that's something you need, such as rent, mortgage, debt, uh, paying for groceries, all of those things, expenses. If you want to take your family out on a vacation, that's going to cost money. That's essentially what you're working so hard for. But if you don't have time, how can you enjoy your life? And really, this is what we need passive income for. Having passive income, you have revenue streams that is unrelated to how much time you spend. So you can, not allocate all your time at a job, but have a system set up where you're getting positive cash flow. So looking at this, the amount of cash you're earning and the amount going in minus the amount of cash going out is essentially your accumulation of money, how much you're saving on a monthly or yearly basis. Essentially, the more money you make, that's more than the amount of money you're spending. That difference is how much you'll be able to save. So, I mean, do you really need passive income if you're making $1 million a year, but at a very young age and you're living at home and have no expenses? Probably not. You'll be very rich, you'll be well off, you have all the time in the world. But this is very different, right? If you're not one of those people, if you're working, grinding away, working minimum wage jobs, and you have to pay for apartments, and then this is something you need to accrue your net worth and have it work for you. And I will talk about this later. The combination of spending less and earning more and using that saving and accumulation of wealth to invest and to really grow that money is really the core foundation of this new movement called FIRE, Financial Independence Retire Early. Um, I think this is very interesting because not only is it a technical way of how to grow your income and have a passive income stream early on and retire early and use all that money as a safety net, and then really retire and enjoy your time earlier on rather than spending all your time working at a young age. But also, it really brings out, what brings you happiness? Do you really need to spend all your money on something you don't need? Do you need that, fancy handbag or the newest iPhone that's almost exactly the same? Is really questions what exactly makes you happy and why do you need to spend certain things to be happy? So it's very interesting as well. So I think I don't want to get too much into, the philosophical side of money, but I think this really plays a role into is what you're spending your money on worth the time that you have to work to accumulate the same amount of money back. So is it going out to eat at a place for $20 worth working 2 hours extra at your job to break even? So if you relate everything you spend back to the amount of time and hours you work, I think it brings a lot of different context into, what exactly are you trading? It's not $20, it's not $30, it's hours of your life that you could be doing other stuff. This really helps put in context of how money flows and what you're doing and how you're trading your time away for frivolous purchases. So very interesting. So the idea behind everything is to spend less and earn more and accrue savings as fast as you can while you're still young and put that money to work for you. Money sitting still in cash and in savings account is you're losing earning potential. And if you put your money to use in a smart investment, that becomes a passive income stream and it grows faster. So let's focus on this a little more. Strategy to put your money to work. What exactly do I mean by that? So as I said before, the idea is you want to have more money coming in than money leaving. And then with the money coming in, you have your checking account maybe for your daily expenses and the savings account, but also the investment is very important. And based on what you invest in, that grows itself. So the amount of money, the more money you have, the faster this grows, and therefore the more money you're getting. So it's very compounding. Let me just show you what I mean by that and how much of a difference it makes. So let's look at this. You have a passive saving account of 2% interest rate. Right now it's probably a lot lower, but let's just say 2% to be safe. And if you have a 5,000 initial investment with different monthly contribution, meaning you're either saving $500, 1,000, 2,000, or $4,000 a month, very different rates of saving. How long does it take for you to become a millionaire? So this is a very interesting question, right? So if you're saving $2,000 a month with initial savings of $5,000, it'll take you around 30 years. So yeah, if you anyone can become a millionaire if you're just constantly saving. This is, small good decisions, consistency. You will be a millionaire, no problem. But if you increase that to $4,000 a month, double your savings a month, that time reduces down to 17 years from 30, almost by half. So this is very important. It shows that, small good decision makes a lot of difference in the long run. So if you save a dollar here or a dollar there, it accumulates and compounds. So now, what about how well you invest your money? So if you compound that with your investment decisions, how much of a difference would it make? So now we're looking at the same example, right? Of 5,000 investment. Now let's look at $1,000 a month where we weren't even able to get to a million after 30 years with 2% interest rate, 2% return. So look, at the 2%, it's still down here, but if you're able to get 9% return per year on average over the 30 years, you'll make your first $1 million maybe at 24 years, even when you're only saving $1,000 a year. Remember that if you're purely saving, putting a high yield savings account, and you deposit double that, you'll make the first million at 30 years. So even though you're putting in less money every month, with smarter investment decisions, you actually get there faster. And then look, if you're getting 15% return a year on average, you'll get to the $1 million in 17 years. So this is very important. These two ideas go hand in hand together. You need to make constant good decisions of saving and maintain that. At the same time, you want to invest your money wisely and get a good return every year. So these two ideas together, compounding, is really what brings the ideas together to get a passive income strategy that works for you and build wealth fast. So now, looking at passive income strategy, how much do we actually need to retire to the point where we don't need to work anymore? And I think this is the ultimate goal of saving as much as we can, reducing our expenses, living a frugal lifestyle, is reach a point where we don't need to work a normal job anymore to sustain our lifestyles. And this is going to be this is going to vary person to person depending on their lifestyle and how much money it takes for the expenses of the lifestyle, where they live, cost of living, all of those things, right? But the idea is that your growth based on your portfolio and your net worth, your passive income stream, needs to be the same or higher than your expenses. So I think an average income of $100,000 would suffice most people's, you know, annual expense. Maybe a little more, go on vacation, buy a couple luxury items to suit to indulge in. So if we use this example of $100,000 a year, how much net worth or investment do we need to have this passive income stream? The idea is the short answer is about 4% of your total net worth is really your passive income annually. And this is based on, assumption of conservative assumption based on the growth of the market. If you have it in blue cap dividend stocks that pays a 4% yield, your investments will stay the same while you get your 4% every single year without draining your account. So essentially, you have a bunch of money sitting there, but it's paying dividends to you, and it's maintaining the same, and you're getting positive cash flow from doing nothing. And that's the whole idea. So we're not doing anything. We're not allocating our time, resources, money, anything to this. We're just getting paid at this point because we spend a lot of time building this passive income stream. And that's really the beauty of it. So what do we need to do for investments exactly? As I showed those rates before, well, you can't just put it into high yield savings account as I showed before, because the rate of growth is way too slow. So you really need to put your money into appreciating assets. And what do I mean by that? I don't mean cars or anything that depreciates in value. A house, people think of it as an asset, but a lot of the time it's more of a liability. You do have a place to live, but think about the monthly mortgage payment. That's an expense. That reduces the amount of money you can save. So it really comes with a understanding of cash flow and how certain things really impacts that. Anything with debt, that's an expense that reduces the amount of money you can save every year. So a house, although you don't need to pay rent anymore, depending on how much you're paying on monthly mortgage, it can make a big difference whether as an asset or a liability. If you're buying a house and you can find roommates and rent out the rooms where you're living for free, where you don't pay rent, and and your mortgage is covered by you collecting rent, that's a definite appreciating asset. You're you're essentially evening out the mortgage and then not paying rent at the same time your house is appreciating asset. That's wonderful. But if you're buying a nice mansion for yourself and then you're not getting any cash flow out of it and you're paying $5,000 a month on mortgage, that's definitely a liability. Some other, basic examples of appreciating assets are stocks, bonds, real estate. If you own a business, um, have them kind of positive cash flow. I mean, these are more risky compared to the first three. And then, anything that appreciates value, even Pokemon cards, all the hype now, if you have Pokemon cards and you think it's going to go up in price, you could definitely hold on to it and sell it later. But I mean, these are completely speculative markets, obviously, but just some example for you to look at, what is an appreciating asset and how you choose to store your money and invest it. So now, let's go with the same example. How much money do we need for that $100,000 a year passive income? And that money was about 2.5 million. And how long would it take us to grow that? Looking at the different interest rate, right? Different return. So starting at an initial investment of $5,000 and we deposit $1,000 a month with a different return on our investment, how long would it take? So looking at, if we are able to get an average of 15%, we'll actually get there in a little over 20 years. So we'll get there eventually. If you start this around 20, by 40, 45, you reach financial independence. You don't have to do anything. You don't have to work anymore to get $100,000 a year. I mean, that's honestly amazing. But if you the thing is, as the more you work, the more experience you have in the job market, and the compounding effect, you'll be able to save more than $1,000 a year. So this is a very conservative estimate just based on what we're doing. So you could probably reach that in 15 if you're saving more and more money as you progress in your career and have an increased income. So this is very important. This is just to illustrate that it's not impossible to become financially independent at an early age. You don't have to wait until you retire. So now let's look at this again. If we double that, if we're able to work more, for instance, we're save more money and spend less, and we're able to save $2,000 a month to put into investment. And look at this, the 15 years, now we're down to about 17, 18 years with a 15% return. But if we're able to bump that up to 20, that's even reduce it even more to about 15 years to reach the 2.5 million. And look at this. I mean, if you're doing the same thing, this just grows parabolic. Within 25 years, you're about 15 million if you continue this. So it really illustrates that the more money you have, the faster the money grows. It just runs away. You become very, very wealthy very fast. That's why it's so important to really save the money and invest it early on to really increase this ramp up speed. And the thing is really, really important that if you increase your monthly saving from 1,000 to 2,000, you're really reducing your retirement time by 5 years. And I mean, that's a long time. Not even retirement time, financial independence. You can keep working, but you have the freedom to do whatever you want with your time because your income and livelihood isn't dependent on you working at a job and how much time you spend at the job. So you can definitely take more risks with your career. You can explore other career path that um, may not be as safe in terms of income. And then finally, years to reach financial independence. This is very important. Um, so starting off with an initial investment of 5,000 in initial investment, right? Same thing, $2,000 a month of saving. So we have, how long does it take you to reach 2.5 million at a different interest rate? At 5%, it takes you more than 35 years. Sure, you can put it in some very safe um, bonds and whatnot, and that's fine. But as you increase the amount of annual return based on how much risk you're taking and what kind of investment strategy you have, you really drop off the retirement time really fast until you reach a certain point that kind of slows down. Going from 35% return and 35 annual return to 50, you don't really reduce your retirement time by that much. I mean, by retirement time, I really means um, the time it takes you to reach 2.5 million. But if you need 10 million to retire, that's equivalent to your luxury lifestyle. This will look very different. This will, from 35 to 50% in annual year rate, will make a very different time when you reach 10 million. So understand this is relative to 2.5 million.
So this is very interesting in that you need to account for the risk. If you're planning at a certain time of retirement, a certain time to reach a certain goal in terms of wealth, you really need to know that by taking more risk of wanting with a 30% annual return target to 50%, you're not really reducing your time by that much in terms of your road to financial independence. It might not be worthwhile taking that additional risk to save 1 or 2 years from retirement. And what kind of risks are associated with these type of annual yields, and what kind of financial instrument are we talking about here? So um, over here we have the same thing, annualized volatility. So pretty much looking at risk and annualized return. So how much percent we're expecting. Treasury bonds, very low risk, sure. I don't think a country is going to default, especially the United States. Government bonds, exactly, all of these things. But you're getting very low yields from these things, so it makes sense. The less risk you take, the less reward you get. And then basically, it goes up to all of these things: global stocks, gold, non-US stocks, high yield bonds. And really over here is what most people invest in, US stocks. You have, moderate risk associated with it and moderate return. And really the 9% I showed as an example is the 30-year annual return. If you just put your money in the S&P 500 index, the average about 9% return. And usually the stocks always go up with, you know, year to year volatility over a long time, over, decade plus, it's always going up. So there are risks associated with it, but you need to understand the volatility and how to manage risk in the time frame that you're looking at. It might go down 20% in a year, but within 10 years, that's just noise. So back to this curve, how are you gonna get 50% return in a single year? I mean, that's extremely high, right? Yeah, absolutely. This to If you're investing in the stock market and expecting 50% return, it might be very, an optimistic assumption that you can do that. And I mean, you definitely can, but what it really entails is that you need to spend a lot of time researching the market and company and understand what each company is doing, how they have advantage of what their advantages are within their sector, and their potential to growth. So you're essentially spending time to do research and really picking the stock, but your total return isn't linearly correlated with uh, the income payoff, such as a job. For a job, if you work 10 hours, you make certain amount of money, but if you work 20 hours, you make that double amount of money, presumably, if you're working hourly. But for this, the amount of time you spend isn't necessarily related to your returns to a certain degree. You can spend 10 hours researching one company and have it all figured out. But if you only have $100 to invest, if you double your money, you make $100. So in that 10 hours you spent, maybe you made $100. But if you have capital, if you have $100,000 to decided to take a leap of faith with your research, that 10-hour research, if that stock price double, you made $100,000 in that 10 hours. So that's a very big difference in terms of how that time is being used and what that return on your time is. It's not linear. It does take some time, but you're not your return on your income isn't based completely linearly correlated amount of time you spend in. So another thing to look at is, how do you prioritize your money? We talked about the type of yield you should look at to grow your investment to where it needs to be to have absolutely to completely sustain a passive income where you don't need to work anymore. So how do you actually put that in place? So you have, so for example, monthly income comes in. Where does it go? How do I invest it? What do I need to do? Do I pay debt first? Do I put an emergency fund? So this is very traditional priority money flow. You have your emergency fund, typically 3 to 5 years of expense, 3 to 5 months of expenses, in probably a savings account that's liquid. And after that's fulfilled, you put into a company 401k where they have a matching, up to the matching contribution. So you're essentially getting free money. That's great. And then you pay off debt, especially the high interest ones. And then you put it into a retirement account, either a Roth or traditional IRA. And then after that's maxed out, leftover money can be put into a 401k for your company. And then after that's maxed out, you can put into saving and other investments, such as just a normal brokerage account. So this is a very, I would say, safe and traditional way of doing it. Depending on your risk tolerance and the amount of active management you want to do in the stock market, you can do something completely different. So this isn't set in stone. I actually don't have a lot of emergency fund. Most of it is actually in a brokerage account. I will get to that a little later, but I do agree. You need to the first amount, a lot of money needs to be put into company 401k up to the employee match contribution. I mean, that's absolutely free money, no strings attached. You should use that. And in terms of debt, you should pay off debt that is high in interest. But if you have debt that's 2%, yeah, pay it off. Pay off the minimum payment because you will ruin your credit score. But you don't need to pay off that debt all at once. It doesn't make sense to spend all your capital and saving that you could be investing, paying off a very low interest debt that's 2% or whatever. So that depends on what your expected return is. For example, if you have average return year to year about 15%, and if you have debt that has interest rate of 5%, you can spend all your money that you to pay off that debt faster, but then you're taking away money from your investment. Instead of making 15%, you're reducing the payment of 5% interest. But so if you take that money of making putting into investment and making 15% a year, and then paying that interest of 5%, you net about 10% positive rather than just using all that money to pay off the debt. So this is really depending on your risk tolerance and how comfortable you are doing that. But absolutely pay off the minimum amount of payment for debt every single time. But you don't need to pay it off all at once. Going back to the emergency fund, if you have a brokerage account with stocks, you can actually use your stock as leverage and borrow money against it. And you don't need to use that money, that margin as they call it, for investment purposes. You can use it and you can take it out of your brokerage account and use that payoff emergency. So this is something I actually do because right now I don't have a lot of expenses. I don't foresee a lot of need for a lot of emergency fund. And the things that might come in as emergency wouldn't exceed that amount of money. So I can use my shares as collaterals and borrow money against it and have that liquidity and have that money really fast to use it as however I see needed for the emergency. They do, however, charge an 8% interest rate, but for something that's an emergency that I can pay back later when my next paycheck comes in, I don't absolutely don't see the problem. Obviously, it's a lot more risky than having just an emergency fund, but having that money in an investment account where it's growing seems more beneficial to me. And this is a personal decision, and I don't recommend it for anyone who aren't comfortable with that level of risk. So this is essentially the allocation of income when it comes in, how it should be spent on saving and investing. So what should you actually invest in? So let's look at some examples. Passive stock investing strategy. These are essentially low risk, very passive. You don't need to understand the market. You put it in, you leave it, you don't really look at it ever again. You just let it grow by itself. Give it time, give it room to breathe. Don't freak out if it drops in price. It will grow. And it's very diversified. You're not going to lose all your money if a certain sector tanks. So looking at index fund and ETF, these are just a pool of companies that you can buy together in a basket. Um, so some of the ones I really like is RK, RG, RW, essentially um, from the from ARK Invest that has very high returns. It's an actively managed fund that that means that they're constantly doing research on the market and the sector they're investing in and buying and selling as they see fit and um, changing their portfolio to the market. And if you look at the rate of return this year, um, the return is more than double it's more than double. So if you were to buy one of these funds a year ago for $100 worth, you would have more than doubled your money, and that's actually absolutely amazing. Is this type level of return sustainable? Probably not. I mean, we had a crazy bull market this year. That could be why. And two other ones that are very popular is SPY and QQQ. SPY is index fund for S&P 500, big companies, 500 biggest company in the United States, and QQQ is the Nasdaq, pretty much 100 companies that are very tech focused. And these are the returns. So 17 for SPY and 46% for Nasdaq. And those were numbers that we were saying is very a near impossible return, but you can definitely do it if you make the right investments. And depending on the market, it's absolutely doable, even if you buy index or ETFs. And what about something that's more passive? If the market is not very bullish, just kind of stagnant, or even a bear market, a lot of high dividend paying stock is actually very beneficial. The stocks don't move as much compared to these growth stocks, but they pay you dividend. They pay you for owning the shares. So some of the really good example I really like is, AbbVie, Walgreens, ExxonMobil, AT&T, Pfizer. They all pay dividends above 4%. So if you have $100 worth any of these, they'll pay you $4 a year just for holding it. Um, you know, even $8.60 for XOM. So these are very low in risk. So what people typically do when they're younger is they have a lot more growth stocks to really grow their investment really fast, taking more risk, because if you're not looking to retire for 10 years, if you if your portfolio tanks by 20%, it doesn't matter. It'll probably bounce in the next couple of years. But if you're reaching your retirement age, where your expected age where you want to reach financial independence, you don't want to have as much risk, because having a setback of a 20% decrease in portfolio value can slow slow your retirement time by a couple years, and that's a big deal. So what people do is de-risk and switch from growth stocks to dividend stocks towards the end, because this 4, 5, 6, 7% yield is essentially the 4% that we're looking for in terms of the positive cash flow for the passive income. So if you want to pick stocks, how should you do it? So how I do it is really investing growth sectors. Sectors that are growing. For example, obviously not malls or retail, because those are slowly dying off. Online shopping is more of a growth sector. And obviously strong companies. Ask yourself, will they be there in 10 years? What about 20 years? How integrated are they in society? Can you imagine a world without them? Um, are they profitable? How much money are they making? If they're not profitable, what are they planning on doing to become profitable? How is their management? Are they reliable? If they promised something 2 years ago, did they actually come through with a promise? What is their future guidance? How ambitious are they? Where do they want to lead the company? Who are their competitors? And based on the competitors, what makes them better than their competitors? Maybe the competitor is better. And then again, risk versus reward. Do you want to be in a relatively new company that hasn't really established itself but looks promising, has a lot of potential for growth? Maybe you can 10 times your investment, but or they can go bankrupt. Or you can invest in something like Apple, obviously very well known, very balanced, still has has one of the best balance sheets in the world and strong market leader in what they're doing. Um, Uber is one of those new up and coming companies. I mean, everyone's know about it, but is obviously more risky compared to Apple. Uh, they're still not profitable, but if you think about will they be here in 10 years and how integrated and how much society relies on them, when was the last time you took a taxi? Everyone just Ubers everywhere. So, and I think, yes, they will definitely be here in 10 years, but how will they become profitable as they're still not profitable? So these are a lot of, speculations that we don't have completely answers to. So there you have it. This is the beginning intro of what rates of return are we expecting, how much you should be saving, some kind of guidelines to build the foundations of really having a passive income stream. So the next time we'll get into more ways of providing passive income outside of just stocks, and this is really looking at option income strategies. I think owning stocks itself is very important. It gives you assets. It gives you things that grow by itself, making your money work for you. But if you think about real estate, you can buy a house and it appreciates in value by sitting there. That's what stocks are doing. But the thing with real estate is you can rent it out. Um, it brings you revenue, brings you cash flow. It does something. Having stocks sit there really doesn't do anything, right? And this is absolutely not true. You can use options and sell premium on using your shares of a stock and collect money. Essentially, it's similar to how you think about using a house as and renting it out. You're essentially renting out your shares to rights to those shares to other people, and they pay you for it. So using this, you can collect a decent amount of passive income on a weekly and monthly basis. So this is very important. It can drastically increase your free cash flow every month. So if you guys found this video helpful, please leave us a like and subscribe, and click the bell icon so when the second video comes out, you guys will be notified. Great, thanks.